Liquidity forms in many areas in the market and has a big bearing on whether you're going to win or lose. One of the areas liquidity forms is around supply and demand zones. So in this class, I'm going to teach you an advanced liquidity trading strategy to help you avoid losses, improve your accuracy, get higher win rates, and ultimately become a better trader. If you're new to liquidity, I'm going to explain it to you now. If you're not new to liquidity, use the chapters to skip ahead to the start of the next chapter, and we'll start on the more advanced technique. So liquidity in a market refers to orders. Orders generally in the form of stop losses and buy stops and sell stops. There are two very common forms of liquidity and two that we'll be using in the more advanced method. These are equal high, which is this one here, and equal low liquidity, which simply refers to support and resistance levels, and then ascending and descending trend lines. General retail education suggests when you see a resistance level in a market, you should look to sell that resistance, okay? So after the second tap forms, anywhere from there on becomes a good selling level. Now, the general idea there then is when you sell, your stop loss will go above the resistance, because the idea is the market is likely to react from this resistance level and trade down without breaking above. So we know from this there is going to be a lot of traders with stop loss orders above the equal highs. So here we have stop losses. Now, as well as this, we have breakout traders who will be looking for the market to push up and break above a resistance level, and then use it on the retest as a support to buy from. So as well as stop loss orders being above the high, we're going to have buy stop orders, which are automatic buy orders. Essentially, this creates more liquidity and more orders above that level. Now, if we think about what a stop loss is, in the case of a sell trade, it is an order to automatically buy back contracts for more than you sold them for, because a short selling order, i.e. selling at these levels, is simply where you sell with an obligation to buy back later, regardless of whether it's a higher or lower price. So stop losses in this instance are actually buy orders. We have a large amount of buy orders above this level, now in two formats, in stop losses and in buy stops. Now, if we have a massive amount of buy orders above this level, so that creates a lot of buy side liquidity, what do we have as a potential opportunity here? Well, let's say you are an institutional trader, a bank, a firm, or simply a large player with massive amounts of money, multi-million dollars, and you want to place large orders. Now, if you think about where we are in this point, underneath this resistance, if you want to sell millions of dollars worth of a contract, you will be left with a pretty bad price. What will actually happen is you'll sell some, and your movement could drive the market down because the amount of money you're working with is so large. So then your second execution may be here, you may get a third execution here, and so on. You're going to have a bad average price because the selling you're doing is actually driving the market down, meaning you'll never be able to get your full order on at this good level. So if you're expecting the market to move lower and you want to sell into that, what you can actually do is wait for this liquidity to be hit, and this is going to open up lots of buy orders. So if there's not enough selling pressure here, there may be buying pressure enough to push us over the high into this area where lots of buying orders are going to be triggered. When all of these buying orders in the form of buy stops and selling stop losses are triggered in this region, there's going to be a massive influx all at the same time of buying taking place. And if you are a massive seller, you have now a lot of liquidity to take on the other side of the trade. If there are now thousands of buy orders being executed at the same time, you can execute a massive amount of money's worth of sell orders. And that leaves us with this format, which is what we call a liquidity sweep or a false breakout. The market pushes above and stops out anyone who sold the resistance, and it also triggers in anyone who wanted to buy the break retest. And then the large player can take the sell on the other side of all of these buys, which will drive the market down. So it creates a scenario where you end up losing before the market moves in your favor. Now, equal lows work in exactly the same way. We have buying taking place upon a support floor. We have lots of stop losses underneath. These stop losses are automatic sell orders. Basically, if you've bought contracts on that resistance, so basically if you've bought contracts on the support floor around here, your stop loss will be set to automatically sell those contracts back for a loss if the market gets down here, so that you don't take a massive loss. So that creates lots of sell liquidity, okay? Now we also have sell stop orders, automatic orders that will trigger sellers into trades if the support breaks, because they will anticipate further downside movement. So we now have lots of sell liquidity. If you are a massive institutional buyer, the market getting into this region will trigger loads of liquidity for you to take the other side of. So then your large buys can be executed easier from down there, and the market will make its run to the upside. So as you can see, buying from support and selling from resistance, what should be a good way to trade, actually has a large flaw. And that's the fact that institutional participants who actually have the power to drive markets are not executing at these levels and are more likely to be executing above and below. So selling from equal highs and buying from equal lows is generally never going to be a good idea. Now let's talk about trend lines. These work in very much the same way. The idea with trend lines is, after the first 2 taps of a trend line have been created, any further taps from there should be good for buying. So we will have traders who are looking to buy another retest of the trend line. Now, what do we have here? Well, again, we get this liquidity problem. With lots of buying taking place here, we have lots of stop losses underneath that area. We also have traders who are looking for break retest trades. So they will be looking more so for the trend line to break, pull back, retest, and then sell lower. So as well as having lots of stop losses here from the buyers, we also have lots of sell stops here for the breakout traders, which creates a large pool of liquidity again. So what we'll generally see happening in the market is, instead of a clean test or instead of a clean break retest, we will oftentimes come through the trend line, sweep all of this liquidity, and then move higher, which ends up stopping out the traders on the buy side and stopping out the traders on the sell side. And again, it happens because of all the liquidity that larger players can take the other side of. In a descending trend line, it's the same. Any sellers looking to sell a retest of a trend line here, or any breakout traders looking to buy upon the break, will have considerable number of orders and liquidity in this area. So if the market is able to get into this area, we then oftentimes see the market just come back down like this, creating a false break and again stopping out the buyers and the sellers. So that is the basic liquidity that you need to understand. Now we're going to move on to the more advanced approach of these inducements and the liquidity around supply and demand. So while the concepts of liquidity, structure, supply and demand imbalances all go together in the form of price action, or what some people call smart money trading, we still need to be aware of liquidity around areas of supply and demand. So in this instance, we're going to be looking at a supply zone, which is a zone that we would look to sell from once the market returns to that level. Now, in this hypothetical example, what we want to make sure we are doing is considering factors of liquidity like equal highs, equal lows, and trend liquidity when we're looking at our supply zones. So if we were to come into a supply zone and formulate this kind of price action, where we create this equal high area, this double top area, we realistically would not want to sell from here. And the reason is because although we are reacting from the supply zone, we still have this factor of liquidity, and we still may be looking at what we can call an inducement, where we could be drawn into the market or lured into a sell before the market takes out those highs. So let's say we sold here and we were expecting the market to continue running down. The risk that we run here is that we actually get a push up to take out the equal highs that have been formed. And the thing is, this is quite a common thing to occur. So when we create equal highs like this, or what we could see as a double top or resistance inside of a supply zone, it doesn't mean that we're going to get that immediate drive away. And what will commonly happen is we'll actually drive up and take those highs out before making the sell move. Which means if you were selling beneath with a stop above those highs, you would be stopped out. Whereas realistically, it could be a movement like this that takes place. Now, there's another way that things can go slightly wrong here. And that is if we have a couple of different zones to work with, which will happen quite often when you're looking at supply and demand. So we see above here, there is an imbalance into a supply zone. Now, if we go ahead and trust this double top or resistance that's formed here, even if, for example, we reacted from it another time, and we started to see some serious weakness kicking in. We still have the liquidity problem. We still have this area above, which has a high likelihood of being taken out. And as we've said, sometimes it's going to come up and do this. But what can also happen when we create liquidity like this is the market may extend through into the higher supply. So not only do we have to worry about what's going on inside of the existing supply, we also need to make sure that we understand the larger context and if there's any other areas the market may reach to in order to create the large, meaningful move. So how exactly do we combat this then? How do we make sure we're not getting liquidated, first of all, inside of the supply we're looking at, and second of all, inside of even the larger context where there could be other zones that the market will be drawn to?